Hey everyone, this is Chris. Welcome back to my YouTube channel. Today we're going to be talking about how to choose a mortgage rate. Now I'm sure if you've bought a house before, you just want to make it as easy as possible, and you probably just call a few different places and just say, hey, what's your rate? I'm here to tell you today that you might be leaving money on the table if that's all you do in order to ask a question to figure out what rate you want to get. Because the reality is, every bank has a lot of different rates that you could potentially choose from every single day of the week. And so today we're going to take a look at what a rate sheet actually looks like, which a lot of lenders probably won't take the time to show you. And in the end, hopefully you will figure out how to wisely choose a rate. And if I pull up the curtain a little bit, you might realize that by asking the question, what is your rate? You're actually limiting your choices. And so you maybe don't want to ask that question. You want to dig in a little bit deeper. And so when I show you the rate sheet today, you're going to see that there actually is many options, and you actually have the choice to choose a rate. Every bank isn't just offering one single rate. Now, I do want to say the rates that the bank does offer does actually take into consideration how much down payment you have, what is your credit score, sometimes how tight is your debt to income ratio. We can talk about that in another video. But once you have all of those mixed in, then there's going to be a price for every single rate that you have that the bank is going to be able to offer you. So when you actually take a look at the cost of each rate, you actually come to see that maybe just having the bank choose a rate for you or just plucking a rate off the rate sheet maybe isn't the best decision. And like I said, you could be leaving money on the table. And before I show you the rate sheet, I just want to make it clear. Just because a mortgage banker or lender doesn't show you the rate sheet immediately, it doesn't mean that they're doing anything wrong. It ultimately just means that maybe they're busy, or maybe they just want to quick show you the competitive rate in our area, my area, the rate that most places will offer people if they ask for a rate. It's just the simplest answer. They'll do one that has a 1% fee, or the bank could call it an origination or a discount point, or whatever the word is. At the end of the day, the bank is giving you a rate and then giving you a cost associated with that rate. And so it's not wrong. It just means that they're making a choice for you. And so here, let me show you what I mean. So we're talking about rate pricing today. And so what you actually will learn is that behind the scenes, a bank actually has a rate sheet, and that each rate every single day has a cost to it. And that cost is dependent on what the market is doing. And so that's really, when you talk about rates going up and down, that's actually the wrong question, because rates, 6% is 6% all the time. It's not like 6% goes up and down, it's the same number. What's changing behind the scenes is how much 6% costs. There's a cost against the market that you're actually paying for to get that rate. And so the cost behind the scenes is actually what is going up and down. And so here we're taking a look at a rate pricing, or a rate sheet here. At the very top, I just want to make it very clear that there are parameters that I built into this, because your particular situation is going to dictate what the cost is, because every investor out there, every bank is going to be looking at a risk threshold. And so if you have a lot of down payment, if you have a high credit score, you're just seen as less risky. Statistically speaking, nothing wrong with you as an individual. If you have maybe a lower credit score and less down payment, it's okay. Everybody's at different spots, but it's all based on statistics. And so if you are a more risky borrower, that just means that the pricing for the rates might be a little bit more, versus if you are a more seasoned homeowner and you have a lot of equity and you're buying a new home, you might have a little bit more favorable pricing on your rates. And so if you look at this chart here, you can see this is just a random bunch of rates. I just chose a range here today, kind of that's ballpark where the market is today, but it can be all over the place at any given day, of course. So you can see I chose a range of rates from 5.75% all the way up to 6.5%. And once again, I chose a credit score of 740, a loan amount of 80% of the home value. So that's what LTV means, loan to value. From the bank's perspective, they're trying to figure out how much are you borrowing against the house. For you, what that means is that you're bringing a 20% down payment, because the loan is covering 80% of the purchase. Your down payment is covering 20% of the purchase. And then we're just going to assume, and this is kind of average for the country, $300,000 loan amount. Just kind of that's the middle of the road loan amount these days. And so this rate sheet and the costs on this are representative of maybe what that scenario would be. So again, left-hand column are the rates. I just want to be clear on what type of loan we're looking at. It's a 30-year fixed rate loan, which means that all of these rates are fixed for 30 years. They start on the closing day, and if you don't change anything for 30 years, the rate will stay the same. There are adjustable rate mortgages out there, and that's a conversation for another day. There's a lock period that I'm highlighting too. I just put 60 days. That's a typical starting point, because once you get a house under contract, usually your closing date is anywhere from 30 to 60 days after that. And so the lock period is good for that period of time. So that's what the lender's job is to make sure that your lock goes past your closing date, because that's where the money is guaranteed for that window. And then you'll see a column called P&I. P&I is a part of your payment. It's principal and interest. Any loan you get from a bank is going to have principal and interest associated with it. A mortgage is no different. And so this is the portion of your payment that deals with paying back the loan. Your mortgage may have other items added on top of that. Your mortgage payment could have other items added on top. It could have your insurance, your taxes, could be an HOA fee. Things like that could be also included in your payment. But the only thing that deals with paying back your loan is the P&I. So for this chart, that's the only thing that matters when we're trying to figure out a rate. And then the far right two columns kind of go hand in hand. That's the actual cost of your rate based on the market today. And so the first column on there is the percentage of your loan amount that particular rate's going to cost. And then the right-hand column is going to be the equivalent dollar amount compared to your loan amount. So for example, the very top row, if you wanted to get a 5.75% today, hypothetically, that would be you're paying money against the market, because that rate's lower than today's rate. And so you'd have to pay a 1.5% fee, and 1.5% of your loan amount of $300,000 is $4,500. And so what you're doing is you're kind of prepaying interest. You're giving money. That $4,500 is going to be a fee that gets added into your closing costs from the bank. And it's not really a fee from the bank as much as it is you are prepaying your interest in order to get a lower rate than what the market is offering today. And so the $4,500 is an extra piece of your closing costs. And that's why I said at the very beginning, when you ask what's your rate, it's a complicated question, because if you actually look at the rate sheet, the banker has many options. Some options cost money for you up front, and other options, let's go to the very bottom of the chart, other options like this rate of 6.5%, that actually has a percent cost of negative 1.5%, which is equivalent to negative $4,500. And what that means is that if you chose that rate today, you'd be going above the market. Maybe the market average is in the middle of these. And so you're actually choosing a rate that's higher than what the market is. And so what the bank does is they turn around and they give you like a lender credit. So you're actually getting some of your other closing costs paid for upfront with that negative $4,500. That's the upfront. You have a negative charge, so meaning the bank owes you money right up front. And so here's some logic. When all of this is mixed together, it's hard to know what to do with all this information. But there's two things that I usually walk through with every person that I work with. Number one is, what is your risk threshold? How risky of a person are you with your finances? Some people don't want to take any risks. They just want to know they have a safe rate for the next 30 years if they have to have it, and that's just fine. If that's you, then maybe right now you'd want to pay a little bit of extra money up front to get a lower rate, because then that gives you peace of mind that long term, maybe you're really set on having a rate in the fives. You're really at 5.875. Well, then maybe you're willing to pay 1% of a fee, which is equivalent to $3,000. And maybe you're okay with that. Maybe you want to put a little money up front and get yourself a better rate, because long term you just want to know that your rate is under 6, and that's your peace of mind. Awesome. Maybe you are a more risky person, and so in that case, maybe you're okay taking a little bit higher rate in order to get the upfront costs given back to you. And so maybe you want to take a 6.5. You're okay with that monthly payment. So in that case, you're getting a negative 1.5%, which is equivalent to negative $4,500, which means the bank is giving you $4,500 up front. And maybe because you're more risky, maybe your mindset instead is, what is the market going to do? And that's the other question that we need to talk about. What does the market going to do over the next year or 2 years? And if you're a person that's okay playing that game and betting on the market, betting that the market's going to go down, well then maybe that's the risk that you want to take, because this loan's being put together once. These costs that you're paying for up front are given once. And so they basically are good for your loan for the period of time that you have this loan. And maybe a person that's okay with some risk and they want to play the market a little bit, well, they're getting $4,500 up front cash. Whereas maybe the less risky person is giving up $3,000 in cash. Two different mindsets, neither one is wrong. The person that's taken on a little bit more risk, what they're doing is they're betting on the fact that the market's going to get better in the next year or two, and they'll be refinancing this loan in that time. And if they can refinance within a year or two, that they got $4,500 up front. And what that means is that they kind of won. They won the bet, so to speak. Because if you take, let's do some calculation here. This is how you can know if it's a good deal or not, if it was okay to get some cash up front. So let's just compare the par rate today. That would be the 6.125. That would mean that if you chose that rate, you'd have to pay nothing, 0% and $0. That rate doesn't cost you anything. And let's compare that to the person that's taken on some more risk. They're taking 6.5% and they're getting $4,500. So the difference is $4,500 up front. But the difference long term or short term, it depends on how long this loan exists. The difference in the monthly payment is $1,823 and $1,896. That's a difference of $73. So $73 a month and a difference of $4,500. So the question is, you're getting $4,500 up front and you're paying $73 extra per month. And so let's do the math here. Again, $73 a month, and the difference was $4,500 up front. So if we take $4,500, that's the difference up front, and divide that by $73 a month, that's the extra bit you're paying a month, that equals 61.6. What that 61.6 means is that as long as you refinance within 61.6 months, that's 5 years out. As long as you refinance within 5 years from now, you're ahead, because you gained that $45 up front, you only paid $73 a month extra in the meantime, and as long as you refinance any time in between, that $4,500 has covered all of those months of 73 along the way. In a similar way, the other way, if we look at the 6.125 compared to somebody that paid in, let's take that person who did 1% with $3,000. Same thing. There's a payoff in the future to know that they've made the right decision. So the difference between $0 and $3,000 is obviously $3,000. The difference in monthly payment is $1,823, and they paid extra in order to get their monthly payment down to their principal and interest down to $1,775. And that's a difference of $48. And so for them, they've paid extra up front out of their hard-earned money, $3,000, and that saved them $48 a month. The break-even point for them is 62 months, which again, that means that as long as they still have this loan past 5 years, 62 months and beyond, then that means that every month after that point, they're ahead, because they prepaid some interest up front, $3,000, that's the fee up front. They gained $48 a month, so they saved that along the way. The break-even point in the future is five years out. So if they still have this loan 5 years from now, then every single month that they're gaining $48 difference, that's money in the bank for them. So they're getting ahead. And so, like I said, when you're choosing a rate, there's really no perfect answer. It matters what your risk threshold is, how comfortable are you taking a risk, and then it matters what your perspective is on the market. And so built into that would be trust to your mortgage lender. So do you trust them to be watching things? If you want to take a little bit of a risk, maybe hold on to some of your cash up front and then trust that your mortgage lender is going to be watching things and hopefully within a couple years you'll refinance, well, then that risk is maybe worth it. Just to recap, if you're trying to figure out what the rate is, asking a mortgage lender what is the rate today is just far too simple of a question. What you're doing is you're kind of asking the mortgage lender to choose a rate off the rate sheet for you, and there's just so much more to it than that. And so taking a little extra time asking these questions about what does your rate sheet look like, what is your rate along with the cost for that rate, is a much more educated question to ask. And so hopefully the mortgage lender will take time, walk through that with you, ask you questions about your risk threshold, and in the end, hopefully you can choose a rate that makes sense to you and makes sense to your situation. And in the end, hopefully you're saving money and not leaving any on the table, or not giving up any extra at closing than you need to. Thanks again for tuning in to my YouTube channel today and learning about how to choose a rate. Make sure to like and subscribe. We'd love to see you next time.